This podcast is for educational purposes only. It does not constitute financial advice.
Welcome to the inaugural episode of the i3 Investment Insights podcast. Today we're lucky to have a very special guest. He is a member of pension fund royalty and is Professor Keith Ambachtsheer. He's known for many journal articles from the Financial Analyst Journal, the Journal of Portfolio Management, and the Rotman International Journal of Pension Management. He publishes the monthly Ambachtsheer Letter. He's recently published his fourth book, which has been translated into Chinese, and he's just been to China to promote the book. Professor Ambachtsheer, welcome to the podcast.
Thank you, Daniel.
Well, it's probably a good place to start by finding out a little bit more about you and how you got into the pension industry. So, where did it all begin?
Well, there are many ways you can answer that question. The one that I like best, I think, is that I started out professionally as an applier of portfolio theory. So I met Harry Markowitz and Bill Sharp and all those people, and I got a job in the investment department of Sun Life in Montreal, and they had everything. They had stocks and bonds and mortgages and real estate and currencies, et cetera, et cetera. So my first job was to actually learn the theory, meet the people who wrote it, and then learn what a real-world investment department does, and then to see whether the theory could in any way improve the behavior and results of the investment department. So I did that from '69, and it was an interesting period. And the thing, of course, that it comes down to is the people have to behave in a certain rational way in order for the theory to make sense, and that turned out to be a bit of a challenge in many ways. So what changed my career is that I happened to be one of the few people in the world to read Peter Drucker's one and only book on pensions. It was called The Unseen Revolution. He wrote it in 1976, and it basically set me on a track that I'm still on today, 40 years plus later. And what he said in the book was really interesting because he's writing this in the 70s, so the baby boomers are still young, but he could see them eventually getting old, as they now are today in many cases, or getting there. And he posed three big questions about how that would change society, would change economics, would change social policy. And the first one was around, what should retirement income systems look like? What are good, sustainable designs? And that was an important question, obviously. The second question that he asked was around governance and organization design questions. What kind of organizations would be best equipped to actually manage pension systems? So that was the second question. And then the third one was around how do we turn retirement savings into wealth-producing capital? So it was the investment question. And it struck me that those three questions, you could make a career out of trying to answer them, and that, in fact, is what I've been doing. If you look at my fourth book, which just came out last year, it is, in fact, called still The Future of Pension Management, Integrating the Pension Design, Governance, and Investing. So I'm still at it 40 years later.
Well, that's a great story, and it sounds like you've been very fortunate to have a great seat from which to watch the pension industry grow and develop from a number of different perspectives.
The thing that turned out to work best for me, the way that I think I'm most effective, is kind of interesting. I started out in the Canadian military, very large organization, then Sun Life, still a large organization. Then I started a pension advisory firm with some other colleagues, a smaller organization. And then finally, by the time that 85, I was pretty well down to my own with my own perch. And what you can do as an independent that's not beholden to anything is that you can be more forceful about your views, about saying things that that may not be quite corporate philosophy in many cases, but because if you're on your own and you come across as a straight shooter, that tells it the way it is. It turns out there's a market for that.
That's very interesting. So in terms of your views that you've been forthright in expressing, what do you think are the main things that you'd like to see done differently or changed in the pension industry?
If you take the three issues, the design question, the organizational effectiveness question, and the investment question, in all three areas, we can move the yardsticks beyond where we are now. So if you take, for example, the design question, the World Bank did us a favor by proposing a three-pillar pension system as kind of a generic starting point, and that allows you to ask, the big questions around Pillar 1, which is the universal public piece, Pillar 2, which has to do with workplace pensions, and Pillar 3 is basically where you make it up on your own. And in each one of those three dimensions, there are issues today, and there are better ways of doing things than current general practice. If you go, the governance, organization, design route, same story. We know a lot about the way currently things are being done, the kind of barriers to better organizational performance that are out there. We kind of know what they are and what we would need to do to enhance that. And then on the investment side, the same thing. I drag in actually a lot of Nobel Prize winners. And John Maynard Keynes never got a Nobel Prize. I guess he was too early or he died too soon. But he turned out, not only was he a great economist, but he also ran the endowment fund for Cambridge University. And so he actually had some very acute insights as an institutional investor himself. And he basically, in his 1936 book, he said, look, there's two kinds of active investing. One is what he called speculation or trading, and the other one is wealth creation. So one's very short-term oriented, the other one's very long-term oriented, and that's a profoundly important idea that we're still struggling with today. Of how do we get out of the high turnover short-termism trenches, and how do we really use capital to create wealth? It's still a challenge even today.
Definitely. So if you had to think about the top three impediments to long-term investing, what do you think they'd be?
One is behavioral. It's the way that we're wired as humans, and it's appropriate, in fact, that the Nobel Prize just went to Dick Thaler, and he's a behavioral economist, and he describes in great detail how human behavior is often inconsistent with the rational behavior that theory assumes. So immediately that sets you off on a track of, given the reality of how people behave, what does that imply of how we should design pension systems? That's just sort of one example of taking theory and observation and turning it into better outcomes on the design. And you can tell similar kind of observations on the investment side. Back to the long-termism question. So the first one really is behavioral. It's just understanding that we tend as humans to have a short-term orientation. That if we're going to have disciplined long-term investment programs, we're going to have to build systems that basically encode that into the culture of how investments are managed. And that's a big thing. Most organizations today in the world don't have that culture. And even though they may say they're long-term investors, they're really not. So that's just the behavioral thing. The second thing about impediments to long-term investing is, this is another Nobel Prize, George Akerlof, and his economics prize was for explaining the importance of asymmetric information in how markets work. And so, the basic idea is that if the sellers know more about what they're selling than the buyers know about what they're buying, guess what? The sellers win at the expense of the buyers. The buyers will pay too much for too little. And it turns out that the market for investment management services is maybe the biggest market in the world that suffers from asymmetric information, which means that investment institutions, if they choose to do so, can basically pick off retail investors because they just know more about how things work than retail investors do. So you've got a fiduciary duty problem, let's call it that, and an incentive to promote and engage in behavior which is not in the best interest of the clients. And then I think the third impediment to truly long-term investing is information. A lot of the information that we get, I mean, you can turn on the television, right, 24/7, and you turn it to the financial channel, and what do you get? I mean, you get day-to-day stuff. If you look at, industry reports, they tend to be short-term oriented. What's next quarter's earnings going to be? What's the expectation? Where's it actually going to come in? And is that going to make the stock go up or down? And so, if we don't provide people with long-term information, or information that matters in a long-term context, sustainability data, for example, then you're going to get short-term behavior. So those are my three impediments. It's the wired-in factor from human behavior, and what you can do to counter that. The tendency or the incentives for, in fact, using short-term behavior to game the customer. And third, turning short-term information, which we're always inundated with, into a different information set that really informs us with respect to long-term investing.
I think that's a very important list, and I definitely agree with all of the points, in particular the third, that the information that you look at really should align with your investment horizon. If you're a long-term investor, then regularly feeding at a diet of short-term news is going to make that difficult.
Right, and now we're getting to a really important heart of the matter is, what does relevant material, long-term oriented information, what does it look like? What is it? Where does it come from? And how is it best presented? And this is a real shortcoming in today's professional world. We're great at pumping out short-term stuff. We're not very good at thinking through, what are the drivers of a sustainable long-term cash flow? And, what are the impediments to that long-term cash flow, not being a long-term cash flow? And that requires you to think of things like, for example, the impact of climate change may be relevant. The impact of market structure may be relevant. But you're going to have to look you're going to have to look at the organization design of the corporations that you invest in. Do they really have a board that understands the nature of the business and how to create incentive schemes for management that in fact are likely to align the interest of shareholders with inside management? I mean, those are the kind of things that you have to look at and develop material information on if you're going to basically live long term rather than just talk long term. It's a challenge. We're not there yet.
Definitely. So in terms of thinking long term, how should pension funds think about short-term performance or peer relative performance, or should they even think about it at all?
Absolutely. I think that Drucker, one of the great Druckerisms is what gets measured gets managed. So you've got to measure something. But then the question is, what is previous comment is what do you measure that actually has information content? And obviously, short-term returns have very little or zero or maybe even negative information content. So it's not relevant. But on the other hand, and this is this whole question around the notion of a liability portfolio or a reference portfolio, I do think that it's important to turn the mandate of a particular investment mandate, which may relate to a pension balance sheet, for example, to saying, okay, what's a relevant reference portfolio that would be a legitimate alternative to what we're going to do as active managers. And it raises a couple of important questions. Number one, what does that passive alternative that captures the relevant risk exposure of whoever is underwriting or is exposed to the risk of this asset pool. You do need to think that through, and you do need to think about what would be the most or the least risky way of implementing that mandate, and what's the lowest cost way of implementing that mandate. I think you need to go through that so that over the long term, you're measuring an alternative to what you're doing. And some of the people that listen to this may know I started up co-founded something called CEM benchmarking back in 1991. And, it's now 25, 26, 27 years later. And so there are now databases, that are multi-decade databases that capture, certain approaches to investing. And you do need to look at those approaches and look at what they're actually producing net of costs in relation to an investable alternative. So I'm very much in the space that we do need reference portfolios, but they need to be long-term reference portfolios. And again, quarterly stuff doesn't matter. It's only when a certain approach is in place for longer than 10 years that you start to develop some, rather than noise, you're starting to develop information about whether this approach really is a superior approach to just simply, buying the market. So you need to do it, but you need to do it with the right metrics over the right periods of time.
I think that's an excellent point. Benchmarking really has to inform your decision making. It has to help you assess the quality of your decisions and point to ways in which you can improve them, rather than just describing history. I think that's a very important point.
But the thing is that I think there is information in looking at that whole measurement process in a peer relative sense. And I'll give you an example. I just took some data or asked for some data from CEM benchmarking. That was all 10-year data, and it was all put in the context of one group was against liability portfolios, where the liability portfolio is basically the lowest risk approach to meeting a certain set of liabilities. It's typically a high quality bond portfolio of a certain duration with a certain inflation sensitivity. And then it's a legitimate question that if you're going to take mismatch risk to that portfolio, what should you get paid for it, and how much mismatch risk should you take? And then the ex post part is, what actually over the last 10 years, what happened? And then you can not only do that for yourself, but if you also have a peer relative database, that measures the same thing for 100 other organizations, that's interesting information because, you're now starting to get some information about how does the whole group do. And if you get some standout performances, of some of the individual observations or organizations in relation to that, 100 member peer group, it is legitimate to ask what happened. What did these people do that put them, below the zero line in a material way, and what did these other people do that are above the zero line in a particular way? And I did this recently, for example. The Canada model seems to have developed some sort of international following. And I did a recent study, got the data from the CM database in terms of looking at organizations that I think have followed the Canada model for at least 10 years, and looked at their behavior in relation to a much larger peer group. And guess what? They really did have materially higher excess returns at normal costs and normal risk levels. So there's something going on there. And then, of course, the second level of question is, what is going on? What has made the difference? And those are legitimate questions, but they're not answerable, with noise. You actually need information. Drucker called it, information is data endowed with relevance and purpose.
I like
so you
that
gotta have
quote.
Yeah, it's a good one. Drucker's got a lot of great quotes.
In terms of promoting this long-term viewpoint, how should pension funds trustee allocate their time?
Well, there's a fundamental principle in governance, and here I'm talking about the oversight body that basically sits on top of some organization that has a mission and has a management. in that context, what's the role of the board? And the role of the board is, number one, to understand the mission of the organization. Number two, to understand or criticize the strategic plan that management brings to it, to say, here's our mission, and here's what we think the best way is to achieve that mission over the long term. And then once you get agreement on that, then it becomes a monitoring process of how are we doing relative to implementing our strategic plan. And what you find from the research, people that do research on the behavior of boards, what they generally find, too little time on strategic stuff and too much time on micro stuff that often are management issues, not board issues.
So would that argue in favor of increased delegation to internal staff?
Well, what it argues for, first of all, is to create selection processes for board membership to make sure you get the right people. And one of the way that I think about what are some of the key determinants of a great board member. And for me, the number one thing is ability to think strategically. And there's a whole science around measuring people's sort of strategic thinking capabilities. But it's also, I think, fairly obvious from a person's background, and if you do the right kind of due diligence, whether this person has strategic thinking capability or not. So that's that to me is one important criteria as to what you need in a good board member. Another one for me is public service. In other words, you go on a board not to be a hero, not to make a lot of money, but in fact to make a contribution to making the organization a better organization. So that's something that I would look for. And those two things, if you've got that strategic capability element, as well as some rubber on the road in terms of actually having experience, that's relevant to this particular organization, investment, HR, strategic management, audit, then you end up with a great board. If on the other hand, you have a process where board members come out of some, union selection process or some political process where the politicians decide that their friend should be on, this board or that board, guess what? You're not going to get a good board. They're not going to have the qualities that you need for the organization to achieve its mission longer term in a really great, cost-effective way. So the fundamental thing to me is processes that put the right people on boards.
So in terms of regulators, what should be their role in promoting long-term investment?
Well, they need to understand the concept first. And I think that regulators also go across the same range that I talked earlier, from, on the one hand, understanding, being strategic thinkers, understanding what regulation should be doing and what that implies of, what are good rules and bad rules. And on the other hand, being a sort of semi-brain-dead bureaucrat who just, ticks boxes. So to me, you've got the same kind of challenges with respect to, the regulatory function as you would with respect to a board function. Is how do you get the right people in the seats that can think about the fact that what should be required from any investment organization is that it articulates what its culture is and what its philosophy is and what its investment beliefs are. And as a regulator, one of the things that I would want to see is that that there are actually processes in place where investment organizations, go through that discipline of sorting out these difficult questions. And then, the other critical element is compensation. How do you compensate your people? And you can miscompensate in a number of different ways. What happens, ironically, a lot as you look at, pension organizations around the world, is they can't pay for certain kinds of functions. They've got compensation ceilings that prevent them from hiring the kind of people that you need to be really successful, especially, for example, in private markets area. This is I think, the big comparative advantage that the Canadian model has broken through, which is recognition that if you're going to be on top of your game in any kind of private market activity, whether it's private equity or infrastructure, real estate, whatever, that you need people that really understand those markets, that have the networks to be effective. And whether you like it or not, those are high compensation labor pools. And if you can't pay good, the people that you want, even though they'll work for half of what they would make at Goldman Sachs, for example, you're still going to be paying them, much bigger bucks than the typical pension fund employee. And if you can't hire those people, then you have to outsource. And if you outsource, the logic and the numbers tell you that you end up paying up to potentially 10 times the amount of what it would take to insource and do that function internally and pay people in some cases, yes, $1 million, $2 million. So that's just one example of the kind of things that regulators need to understand in terms of business models that they're overseeing as to whether people are doing the right things or whether the thing is going off the rails in some way.
You've mentioned the Canada model a couple of times in your responses. Perhaps you could elaborate a little bit more on what that is and why it's been so successful.
Well, it's the my narrative starts again with Drucker. What comes out of Drucker for any organization, if you get it down to 3 success drivers, it's clarity of mission, good governance, and the ability to acquire the resources that you need in order to achieve the mission. Those are the 3 things. And what happened was that a window opened up in Canada, Ontario specifically, in the 1980s, where the government created a task force to look at the effectiveness or ineffectiveness of the whole pension management investment process. And I got signed up for advisory capacity as the chair of this commission. And so, what got imbued into the recommendations was this notion that pension organizations should have, guess what? Clear missions, good governance, and the ability to achieve the mission by having no resource constraints. And that was a lot different than the actual reality on the ground in the 1980s. And what happened was that the treasurer of the province of Ontario and the president of the Ontario Teachers Federation, Margaret Wilson, decided that, wow, maybe we should create a pension organization that actually has those 3 features. And they did. It's called Ontario Teachers. It started up in 1990. And because they got the right people to actually run the business, it's probably the most successful pension organization in the world over the course of the last 25 years. And then other Canadian organizations started to use the same 3 success drivers, and now it's traveled around the world. And in some cases, it's implementable. In other places, it's not. If you don't have a process for getting a great board, if you don't have a process for actually hiring the people that you need to hire to be successful in private markets, then, you've got 2 hands tied behind your back.
Would something like the Canada model work in Australia, and would it work for smaller funds?
Yes, the smaller funds, they have to. I mean, if they got a clear mission, they got a great board, that they still have 2 things going for them. But to insource, you do need scale. And an interesting question is, what scale level do you need? and that's debatable. I mean, there's no single number. I think anything over 50 billion, you're free and clear. But I think you can do a lot of these things with maybe half that size. On the other hand, if you're a $1 billion fund, you can't. And so for the $1 billion funds in the world, the question is, given that we can't insource, what's the second best? What's the second best thing for us to do? And frankly, for a lot of those funds would be to, figure out, what the right appropriate risk exposures are given, whatever business they're in, whether they're a super fund or a sovereign wealth fund or whatever, and just, buy the market at two basis points or whatever. For a lot of funds that are small, that's the best way to go.
I agree, but we rarely see that happen. I guess funds are somewhat concerned that if they do that, it perhaps highlights the fact that they're not adding much value.
Well, but again, and I've got some money riding on your productivity commission that's going to come out with its report in January, where they make these issues clear, to the world. And if you do make them clear, then you get into some very interesting fiduciary duty questions, which basically are, if it's generally known that certain kinds of structures basically extract wealth from a certain group of people and put it in the pockets of another group of people, is that legal? Is that not chargeable, or is that not challengeable in court? So I would like to think that's where this goes.
Do you think the system that we have in Australia, where we have open competition and super is portable, members can elect, in many cases, not all, which fund to be a member of, do you think that system promotes a better outcome, or it promotes... No,
it doesn't. It doesn't, because, you read George Akerlof, asymmetric information. This is not an area where consumers can make informed decisions. And the idea that somehow competition, will change all that is just wrong. What's required to get good outcomes is fiduciary behavior by boards that are knowledgeable and are required to act in the best interest of their members. That's what creates better outcomes. But I think another big question, and this is interesting, where you've got a future fund that in Australia that is large enough to insource, but it doesn't. Interesting.
It's legally not allowed to.
Well, but if something makes sense that you should be doing, you change the law.
Mm-hmm.
The Norwegians have the same issue. I mean, I had this this discussion in Norway with their, what at that time was called a Petroleum fund, 20 years ago, and they decided they wanted to be largely passive, and to run it out of their central bank, Norges Bank. And they just had a parliamentary review commission that now basically said, well, that might have been a good idea 20 years ago, but it's not now. And in fact, we should adopt it. I didn't specifically call it the Canada model, but effectively that's what it is. Pull the $1 trillion fund out of the central bank, set it up as an arm's length agency, create a great board, and redefine its mission. And if they do all of those things, I mean, I did a study for them just a couple of years ago. It's in the public domain. That basically said, you're basically leaving 100 basis points on the table by running it the way you're running. Mm-hmm. And it turns out that the 100 basis points is something like 10% of the Norwegian federal budget.
Just on the low return environment, and circling back to the discussion we had earlier on long-term investing, I see a lot of funds because we're in a low return environment, and particularly the traditionally diversifying assets such as bonds having such low yields, I see a lot of funds looking at things like trend following strategies or risk parity strategies, which aren't necessarily as long term as what we were talking about earlier. Do these strategies have a place in a pension fund?
Well, I think it's a cop-out. You go back to Keynes, investing is taking retirement savings and turning them into wealth-producing capital. So, what you're describing, how does that relate to wealth-producing capital? What I find that most of these, statistically driven strategies are relatively short-term strategies because they only work as long as you're in the minority and the majority is doing something else. If the majority starts doing what you're doing, it's over. So that just doesn't strike me as a very constructive way to get people into an investment department and say that's your job, is to run all these statistics and try and squeeze a little more return out of the market at the cost of somebody else. Is that really investing?
I think that's a good question for funds to consider. Well, thank you very much for your time today, Keith. It's been a pleasure to talk to you and to find out more about your work.
Thank you for listening to the i3 Insights podcast. For more information, please visit i3-invest.com/insights.